It's time for Ask Mike Mondays. Mike answers one listener's question every week. Here's Michael Becker and Paul Peebles.
Welcome to Ask Mike Mondays. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me, the smartest guy in the room, Michael Becker.
Hey, Paul.
So, hey, listen, we're kicking off 2018. This is going to be a great year. It's going to be Get in the Game in 2018. Get in the Game 2018. That's our theme for 2018. If you're an investor or a managing member, KP, anybody that has to do with buying of real estate, get in the game in 2018. There's still great opportunities out there. So we're going to talk a little bit about that. So Michael Becker, smartest guy in the room. Michael, tell me, how was 2017?
It was a good year. We were pretty active. We ended up buying, purchased five properties, and we sold 3.
5 large properties.
Yeah, we think we did almost 1,800 units. I have to go back and count, but somewhere along those lines.
So you've purchased over, 5,200 doors. You have about $500 million in non-recourse debt.
We've done about $500 million as a principal and over about $500 million in transactions. I think we're a couple $100 million plus in debt right now.
Did you ever think when you were a banker that you would be in such large debt?
No.
I would never think so either, because bankers are kind of risk adverse, and we like giving out the money. We just don't like to take the liability. But what's good about Michael and his team, he does a lot of non-recourse debt, so no personal liability that he has. So that's great. So in the question, kicking off Ask Mike Mondays, which I think is an interesting one. This comes from Victor. Victor asks, what are the personal income requirements to really start on your first deal? How much must be my net worth? How much cash on hand? Do I need to be making $100,000 a year or $250,000 in my current career to be able to invest? I'd like to know more details. Thank you.
Yeah, so I think this question kind of mixes 2 different concepts up. So we'll answer this question in 2 different ways. Really, there's a difference between being the deal sponsor and being a passive investor or a limited partner in one of these deals. So to start from the limited partner standpoint, there's really no hard, fast rules on exactly what you need to do. I think what Victor was referring to is a lot of sponsors that take in investors require that their investors be accredited investors. And so you could certainly Google the term accredited investors, but basically means that you have to have a net worth, excluding your homestead, of $1 million or more, or you got to make $200,000 a year in your job, or $300,000 if you're married. That is kind of what a lot of the minimum requirements for a lot of people that anyone that is required to be an accredited investor, that's kind of what they look for. And then from there, it's just really kind of, do you have a minimum threshold of what you want to invest? A lot of people have $50,000 or $100,000 minimum investment levels to participate in one of the private placements. So that's kind of how we said we typically take accredited investors, or we typically take $100,000 minimum when we put deals out there, for example. The other part of the question really is what kind of is net worth and liquidity requirements if you want to be a sponsor. So from that standpoint, most of the banks, it's really kind of, you back into, we talk a lot about this, you back in kind of what the bank's requirements are for either the guarantors or the key principals, depending if you go with the bank loan, recourse loan, or with Fannie Mae, Freddie Mac, non-recourse loan for the apartment. So to recap on the Fannie Mae, Freddie Mac, their typical minimums are that you have to have a net worth equal to or greater than the loan amount. You have to have post-closing liquidity of 10% or more than the loan amount from the KP pool. So that doesn't necessarily need to be just Victor. It could be Victor and 2 or 3 of his friends, and they aggregate their balance sheets together and say, do we have collectively enough net worth and liquidity to meet that? On the bank side, it depends answers. All these banks are a little bit different, but typically, when I was a banker and I worked at Wells Fargo, kind of the rule of thumb that I went by that always pretty much worked very well as a banker is I wanted my guarantors to have net worth equal to or greater than the loan amount. We look for anywhere from like 20 to 25% kind of as a minimum in post-closing liquidity from the guarantor pool. And that always worked really well internally. But every bank's a little bit different and every story is a little bit different. If the deal's a little bit more distressed, the banker might want to have a little bit more margin and a little bit stronger balance sheet. If the deal they're financing is a little bit more stabilized, it might take a little bit more risk and not quite have as strong of a balance sheet. So it really depends, but those are some general guidelines out there.
Now, being a banker or a former banker, almost like being a former Marine, you guys would require the investor who was leading the deal to put significant skin in the game. How much money does like a balance sheet lender or just a bank require for the investors to put their own money into the deal?
And again, that's a very it depends answer. But at Wells Fargo, we required that 51% of the money come from the people that signed on the loan. So the sponsor and any sort of guarantors had to put about half the money in the deal. That was a pretty high threshold. I think most banks are a little bit lower, but the point is a banker really wants you to have some material, actual cash at risk in the deal. Where if you go over on the Fannie Mae side, there are certain requirements, but it's nowhere near as strict on the Fannie Mae or Freddie Mac side. There's certainly more open to you having, a lot less of the actual cash in the deal. But, just keep in mind they want you to have a significant portion of the cash in the deal. So make sure you have skin in the game is always the term that we use. So they want you to have skin in the game alongside your limited partners.
I want to go back to that question from Victor concerning where are you raising money? I mean, there's a lot of crowdfunding sources out there, Realty Shares, Realty Mogul. Do you guys use crowdfunding sources to find equity for your deals?
We have not to date, but I know that's becoming more and more popular. We've looked into it, but we just fortunately have not had to go that avenue. We're able to fund it with the investor pool that we have that's continually growing through either referrals or just kind of organically.
So is that something that you would probably think about in the future, or just not something?
No, that's something I think is very viable out there. I know a lot of people have done it. From every time I've talked to everyone, we've talked to 4 or 5 different companies that do it. And it seems like every time, one thing to keep in mind, this is not the avenue to get the entire capital stack. They typically want to participate in a portion of it. So, if you need to go raise $5 million, the crowdfunding website might be good for $1 million or $1.5 million of that $5 million slug.
And just your general knowledge, would they put money into the deal if you don't have any experience?
No, they all seem to have some level of minimum experience requirements. Some kind of varies from place to place, but kind of, collectively you have a decade or 20 years collectively with you and your sponsor of deal experience, or maybe it's 4 or 5 years, or you have to do a certain number of transactions or certain dollar amount level of transactions before they actually fund you. So because they're putting their name and credibility on site when they open your investment to their marketplace. So they want to make sure that they do some level of due diligence on the sponsor and make sure that the sponsor has some level of track record and credibility along the way.
Well, sounds good. If somebody wants to get to know you a little bit better, Mike, and to kind of figure out what you do at SPI, what's the best way of getting hold of you?
Yeah, really just go to my company's website, which is www.spiadvisory.com or SPI like spy advisory.com. There's a contact us page. You fill it out, and I'm always happy to set up a 10 or 15 minute telephone call with somebody. So, Paul, what do we have going on in the Old Capital world?
We're going to have a Old Capital speaker series at the end of February, but the one that I really want to put on the table on today is going to be Dr. Dotzer coming in the 28th of March. Dr. Dotzer, if people don't know who Dr. Dotzer is, he was the chief economist for Texas A&M. He is the guy that all investors, whether they're in Texas or outside Texas, really want to get a little piece of nugget, what he talks about. He is not only the funniest economist I've ever met, but probably the smartest guy I've ever met. And a lot of investors listen to him, again, just not for Texas, but all throughout the United States. And he talks about different things. He kind of brings it down to the bottom line. And he will be at the Grapevine Convention Center with us on March the 28th.
That's right.
And you want to make sure that you sign up for that. And we'll push that out probably later next week or two. So look for an announcement concerning Dr. Dotzer. We'd like to get, we had 400 plus 500 people at that meeting last year, and we're looking forward to having him back. So, and don't forget, the 15-page white paper report that Michael and I wrote has just been updated. Just make sure you get there and download that just to get some additional information on how these
Where do you find that one, Paul?
That is on the Old Capital Podcast website, oldcapitalpodcast.com. Great information, just bottom line information about what's happening, how these deals are put together, and how to be successful when you are raising money, because you have a lot of money at risk. So you want to make sure that that best investor, which is your bank, you understand how they put these deals together. So you really want to get that information. So great 2017, Mike. I know that 2018 is going to be even better. So we appreciate everybody listening. I'm Paul Peebles. That was Michael Becker, the smartest guy in the room. Have a great day.